Have you ever wondered how global events or national economic trends ripple through the financial world, impacting everything from investment portfolios to job opportunities in various finance sectors? It is a complex dance, constantly evolving. Macroeconomic factors significantly influence finance sectors by shaping market sentiment, investment flows, regulatory environments, and the overall profitability of financial institutions. This impact is not uniform, varying across different sectors like banking, investment management, and insurance, depending on their specific functions and sensitivities to economic cycles. The core mechanism behind this influence lies in how these large-scale economic forces alter the fundamental conditions under which financial institutions operate and generate revenue. For instance, central bank decisions on interest rates directly affect borrowing costs for businesses and consumers, impacting loan demand and the profitability of commercial banks. When rates rise, a bank's net interest margin, the difference between what it earns on loans and pays on deposits, can improve, but it can also increase the risk of loan defaults. Conversely, during periods of economic expansion, stronger gross domestic product growth typically leads to increased corporate earnings and greater investment activity, which directly benefits investment banking through higher merger and acquisition volumes and more initial public offerings. Understanding these drivers means continuously analyzing economic reports, central bank announcements, and geopolitical news. For finance professionals, it is about recognizing how various sectors react to these shifts. For example, asset management firms must constantly adjust their portfolio allocations based on inflation expectations and anticipated interest rate changes to protect and grow client assets. Insurance companies, while seemingly stable, see their investment portfolios significantly affected by interest rates, as a substantial portion of their assets are invested in fixed income securities, and claims can also correlate with broader economic health and specific events. Consider the concept of a flight to quality during times of economic uncertainty. This is when investors rapidly shift their capital from riskier assets, like stocks, into safer havens, such as government bonds or gold. This macroeconomic phenomenon directly impacts liquidity and pricing across all financial markets and can lead to significant reallocations of capital within investment funds and banking operations. Another example is the yield curve inversion, where short-term bond yields become higher than long-term yields, often seen as a historical indicator of impending economic slowdowns or recessions, prompting many financial institutions to adjust their risk exposure and lending strategies. Ultimately, a solid grasp of macroeconomic factors allows finance professionals to anticipate market shifts, mitigate risks, and identify new opportunities, enabling them to make more informed decisions for their firms and their clients. By staying attuned to these broader economic currents, you can better navigate the dynamic financial landscape and position yourself for success.